What's up, guys? Mike Sharp here. This is Sharp Investing, and I'm going to talk about StoneCo Q3. They just came out today, and I thought I would do a quick video before thinking about it too much, and just to get the info out there, because I didn't do a Q2 video. So here is my Q3 take, and as a reminder, not investment advice. This is my portfolio. What I'm doing, whatever you do with your portfolio, is your business. Q3 actually looks pretty good. I am happy with Q3 just generally. I see some really positive things here, which I'll go through in a minute. I was concerned about this company after Q4 last year and Q1. The revenue really decelerated and revenue growth did. And I was wondering if they were stalling, but it looks like we have a revenue pickup. I think we saw 4.7% quarter over quarter, which is quite good. And the earnings numbers are fantastic. They did a huge amount of buybacks. The EPS growth looks really good, plus some other goodies. So let's just go through the earnings presentation here, and I'll just kind of go through it and chat a little bit as I take a look. So the payment volumes, now they're not fantastic year over year. They're at 12% year over year on cards and 20% including PIX. But PIX is sort of a low monetization level compared to cards. So it's not fantastic, but there's a lot of other good stuff here. So client deposits up to 6.7 billion. That's up 50% year over year. Looking really good on the banking side. They've now got 75% of, sort of roughly 75% of their payments customers now on banking as well. So they're doing a good job of cross-selling these other products. Client base up 21% year over year, up to 4 million. Looking good again. A lot of new clients. They're still adding, but there's a negative on that, which I will go on into later. Take rate is up, and it's past their year in guidance, so they're ahead of target on that one at 2.58. And the credit portfolio, this is the big win here. Now, again, they're ahead of their annual targets after Q3 here. Their annual target for this product was 800 million, and they've blown past it. And so they're just going to crush their guidance for the year on this one. And this is the real growth avenue now. We're going to see that the payment side of the business is probably going to slow down here going forward. And this is where the big upside is. So this is really good to see. And as a reminder, their 2027 targets on that number are 5.5 billion in as their credit portfolio. Okay, so they got 3 years left. But the growth rate right now, I mean, if they keep going like this, they'll definitely get there. So admin expenses, that's fine. Adjusted EBT at 733, that's really high. So I remember my very first video, I said this company has the potential to be a 30-30 business, which is 30% growth and 30% margins, which for me is like, I love growth and I love margins. If you have those two things going, you're probably going to have a compounding business. Earnings are growing really well, but the revenue growth, sorry, not the growth, but the margins are not, I don't think they're actually going to get to 30%. They might, if, because the credit product has a different profile, it's pretty high margin, but I don't think that they're going to get to 30-30, so they're not going to quite get to where I wanted them to get. But right now, 35% earnings growth and 22% margin, earnings before tax margin, pretty good, right? If they did that for a few years, man, this thing would be a monster. So let's scroll down here a bit. Now the revenue, this was the one I was the most worried about. The revenue really had slowed down over the last two quarters, and you can see between Q3 23 and last quarter, they only were up by 100 million. There's some decimal points there that should be there, but they did reaccelerate this quarter, so this is really positive to see. So I think maybe the stock is going to respond to this, because I think that's maybe why it was slowing down. Just a guess. And like I said, 22% margins, these are still looking really healthy. My original goal here was to get to $1 billion in quarterly pre-tax earnings, and so yeah, 3/4 of the way there almost, which is faster than expected. So I'm quite happy to see this expansion in profitability continue. EPS, now this is a big one, right? So we see a huge jump here in sort of earnings growth on a per share basis, and that's up 43% year over year, and that's because they did a massive amount of buybacks this quarter. They bought back 3.5% of the share float this last quarter. I think it was 740 million reais in and that's 10.8 million shares. So they've really done a good job. Now this Pedro Zinner, the new CEO, he's not I don't think he's a visionary tech genius, but he is a kind of a CFO type CEO. So he was brought in to really juice the numbers. He's not there to innovate or anything like that. And it's really good to see that he put the buyback pedal to the floor when the share price was low in the 11s. That's a really good sign. That means they're not doing the thing that a lot of companies do, which is buy back shares when the price is high and then stop the buybacks when they're low. So they're actually doing it the right way, which is fantastic. Payments, slow, steady growth, as they're saying here, still looking quite good. And the take rate, again, like I said, is up to 2.58. So still very healthy on the payment side. On the banking side, this is positive as well, because this is along with the credit product, this is the next growth avenue is the banking along with the credit, right? So the deposits are now up to 6.8 billion reais, which is a really healthy level, and the client numbers continue to grow. They added 140,000 new customers on the banking side. So the cross-selling is going really well. Okay, now here the big home run for this quarter is the credit side. Look at that growth, 30% quarter over quarter growth, and even the NPLs came down pretty strongly here on the early vintages, and then the 90-day NPL is now up at 3.7, but that's still really, really healthy, considering they're actually they originally started writing off, I think it was 20% of their book as potential credit losses. So they're tracking well below that. Now this number will keep coming up as because this credit product's not that old, so there's still a huge lump of customers that haven't hit the 90-day mark yet. So as we start getting sort of deeper into the credit product, this will normalize, and I think it's going to normalize higher, but well below their loss contingencies, which incidentally they've dropped now to 14%. So they're saying that these are tracking really well, and they actually can bring down their estimate for the expected losses. So that added a little bit of a tailwind on the earnings side, because they brought the whole book from 18% last quarter down to 14%. So they didn't have to write off very much this quarter. In fact, I think it was a clawback on that metric. So it's possible that the profitability is going to not expand again next quarter, because they're not going to have this tailwind, but I still think it's all going in a positive direction. Financial services revenue, I don't think I want to talk about that. Software, now this is the dog of the portfolio, right? It never really improves. The revenue never really improves. They don't have very high hopes for it. The margins don't really improve. They're saying it improved quarter over quarter, but if you look year over year, it's actually down. And they did talk about that they're exploring options of what they could do with this. So that means they're thinking of selling it, basically, and then maybe making having a partnership with whoever buys it, so they can keep cross-selling to these customers, which is a little bit weird. This is strange messaging for me, because at the end of last year, they were really talking about how this cross-selling with their software customers was going to be a growth engine, and now they're going to get rid of the software side. So, well, they're not going to. They're exploring options. So we'll have to see how that goes. But that said, the cross-selling is actually going well. This is one of the drivers of growth, I think, in this quarter. So the overlap, that's their ability to cross-sell between the customers that were originally on software has now improved again over the previous quarter. What else do I want to talk about here? So the cost side, I don't love this. I think I've said it a few times, but I don't like how they talk about, we're really doing this great cost management program. It's going to be one of our pillars in the future and all this kind of stuff. But they're only looking at this second line item, right? Which is a very small piece of the cost pie, right? But if you look at their cost of services, just delivering the payments product, basically, that's up 11% year over year. It keeps going up every quarter, and it's actually going up in terms of a percentage of revenue, I believe. I might have that wrong, but I do think it's going up, like just eyeballing it. I think it's actually going up as a percentage of revenue, because we haven't seen this level of, you can do it right there. So the revenue is only up, 200 million, but this is up 80 million, right? So that's a pretty high chunk of incremental revenue that's gone to this cost of services, which is supposed to be a fairly small piece of the pie. So I want to keep an eye on that one. That's not a huge deal, but I just don't like how they're trying to tell me that they're managing costs well, and it doesn't really look great to me, but also not terrible, right? So selling expenses came down. They had this big marketing campaign they did on a show last, or maybe that was 2 quarters ago. And so now it's sort of the costs on this one are normalizing down. That's good. Financial expenses, these ones are hard because there's a lot of factors involved, right? Like, as it is a cost of service, cost of sales, but it's also got the SELIC interest rate that's baked into it. So if that moves, then this moves. So that's a hard one to manage. But basically, cost, not too worried about it. I think it's probably fine, as long as we don't see a big spike. I'll keep an eye on the cost of services, though. Net cash position, this hasn't changed year over year. That's fine, though. They used all the money. Essentially, they used the money for buybacks, which is totally fine with me when the price is down. That's great. And if we go into the guidance, I mentioned this before. They are on target to hit all their metrics this year. They're actually going to blow away a few of them, like especially the credit one. That's the best news here. There looks to me that they have a chance of missing the payment volumes target, but it'll be close because the next quarter 4 is the Christmas quarter, and the volumes will be higher in that quarter. So if they miss it, I don't think they're going to miss it by much. Again, this one is the stupid admin expenses which drive me nuts that they talk about. Why is that even on here? But who cares? Adjusted net income, they're already at 1.53. I think they're going to land at 2.1, 2.2 at the end of the year. So they're going to beat their net income target. I think the market's going to like that. I think the market probably should like this already. I'm looking at after hours. The stock hasn't moved. I'm wondering what I missed, because this looks pretty good to me. I was worried that this was we're gonna see a deceleration, but we've actually seen the opposite. So in terms of just a little bit of a teaser on what I'm looking at, not a teaser, but in terms of the forecasting for my own portfolio here. So if I look at the EPS, they've got $1.97 this quarter as expected. The net, like I said, I'm going to put 2.15 billion as the expected net income for 2024. Based on the new share total, that would lead to an EPS rate of $7.24 per share, and in US dollar terms at 5.8 BRL to the USD, you're going to see about $1.25, which puts this at less than a 10 price to earnings for 2024, which is extremely good for a company that's growing at 38%. Now, I am a huge fan of the PEG ratio. I think if you gave me one ratio to work with, it would be a forward PEG ratio, like to say, okay, what's the growth in the future versus what it's selling at now in terms of the valuation for the growth rate. So anybody who doesn't know, PEG is PE over growth. And obviously you have to like multiply the growth by 100 to make it work. But anything under a 1 PEG is usually pretty good. And this is at a 0.24, right, in terms of the 2024 growth rate that I'm expecting. Now, if we use their target, the company target for 2027, their guidance for that one is 4.3 billion. If they hit that, the forward growth for the next 3 years is 26% per year, which means the forward PEG would be a 0.35, which is extremely good, right? So bottom line, it's cheap. From my view, this is a cheap company. And if I'm using a little bit of evaluation here, I'm saying my target here is $1 billion in EBT per quarter, right? So we're 3/4 of the way there. That would be, that's almost at their 2027 target. They might hit it in 2026. And if we put a 12 multiple on that, then the USD market cap, assuming they don't buy any more shares back, is 8.3 billion, which would mean a share price of almost $28, upside of 142% from here. So for me, this still looks good. It's still a hold for me. I feel good about these earnings because I thought there was a chance I might have to dump it if it really slowed down, but it has done the opposite, and I'm pretty happy to continue holding through the next few quarters to see how they go. But anyway, good job by Pedro Pedro Zinner, the CEO, to buy shares back while it is cheap. That is fantastic, and great to see the EPS up 43% year over year and 22% quarter over quarter. Revenue reaccelerating, like I said. And what else? Anything else here that I want to talk about? I think that the risk I think I keep my eye on here is the currency, right? So that's the one thing that could probably derail this in the short term. Is if the reais, the Brazilian reais collapses, it's fallen pretty hard already against the US dollar, and everything has actually over the last since Trump got in there. But if it falls further, then that's going to be a pretty big headwind for the stock. Conversely, if the USD falls, which actually that's actually where my money would be, because Trump is a dollar down kind of guy. So maybe not right away, but I think that he's going to do what he can do to get the dollar down eventually. And I think that could be a nice tailwind for this stock. So that said, do your own research. Thanks for watching if you got this far. Hit the like button, all that stuff. See you in the next video.